Buy properties now and don't pay for them. Do this instead. That's the topic for today's episode. And without further ado, let's dive in. Hello everyone, and welcome back to another episode at Novarize Invest. If this is your first time tuning into this channel, this is your channel for financial education. So today we're going to talk about buying houses, right? And specifically why you should buy right now. I know there's a lot of noise out there in the media, people talking about you shouldn't buy, you shouldn't buy, you shouldn't buy. And I decided to create this episode for you to let you know that you should buy today and that you shouldn't wait until tomorrow. Now, today's class is going to be quite lengthy. And the reason why it's so lengthy is because it was originally intended for the students, for those who invested in the Real Estate Nova program. But then after, going through the recordings and teaching the class, we realized that it wouldn't be right to just keep that one lesson in particular just for the students. So what we decided to do is just to put it out in the air so that everybody can benefit from this information, because the more we help each other, the better the world we're gonna live in. So without further ado, let's just dive straight into the computer and look at what I've prepared for you today. All right, so buy properties now and don't pay for them. Do this instead. So before we dive into the class, I wanted to share a bit of an anecdote that has been haunting me over the past couple of years, and I couldn't quite get the answer until now. So last year, I was visiting a friend, and this is a childhood friend, and we actually grew up in Venezuela. I left, way before she left the country. And we were just talking about inflation in general. We were talking about the conditions of our home country. And then she said something that really struck me. She said, if I knew the currency of Venezuela was going to go downhill, I would have taken a bunch of debt, get debted, and then just wait for the currency to crash and just pay it back with cheap money. And so at the time, I didn't really understand what she meant. I was like, okay, so you take out debt, but you still have to pay it back. Like, how do you do that? And so I went on a quest and I started researching, learning, investing and paying attention to every single little detail to see if I could eventually start making sense of things, right? And in a way I did. It was a painful process, but we got there, right? So before we even start talking about debt or anything like that, let's just take a step back and start talking about the concept of inflation. Now, I don't want this to turn into an economics class because, one of the biggest fears I had was that anybody would hear about the word inflation or anything that's related to the economy in general was just going to get shut down or just tuned out, so to speak. But it is very important that you understand this, because everything that I'm about to share with you today, it's going to be based on this one simple concept, right? So what is inflation? There are many, many, many definitions out there, but the simplest way to put this down or to define it will be inflation is the rise in prices of products and services in general, right? So what happens when the prices go up? They reduce your savings because you have to spend more money on it, right? Or it will reduce your purchasing power, right? Meaning you're going to have to either buy less of it in order to be able to keep up because, hey, where else are you going to get the money from? So now that you got that clear, there are multiple scenarios in where inflation could play out. There's many of them, but I decided to pick just a few just to give you a general feel of, okay, so let's just start paying attention to see if we're in an inflationary scenario or in a moment during our lifetimes today, right? So scenario one, product cost goes up and you have to pay more. So let's say a bunch of tomatoes back in 1990 was worth $3. Fast forward to 2000, now it's $4. You're still paying for it. 2010, now it went up to $5 and you still pay for it. And then in 2020, it went up to $6. This is possible because you have a job that has the luxury of adjusting for inflation, right? So usually this type of jobs are in the corporate world. And I actually found this article that I wanted to share with everybody. So this is happening in real time. This is not like something that happened in the past and you're like, oh, this is inflation. No, look at JP Morgan. JP Morgan, this is a recent article, CNN Business, June 29, 2021. First year analyst at JP Morgan will now make $100,000. And back then, I think, so there it is. So the salary of a first-year analyst jumped from $85,000 to $100,000. So that's in essence what inflation means in a way. The cost of living is going up, so companies are going to have to adjust that if they want to retain their talent so that they can afford, paying a bunch of tomatoes at $6 in 2020, right? So typically the type of jobs that can't afford the luxury of adjusting their pays to their staff are corporate jobs, right? So that's why I had the article, because they're the ones who need to retain top talent, and their staff has a certain level of skills that they are very well aware that if you don't pay me what I want here, I can just go elsewhere. So there's always that competition between big companies just to attract talent and paying you the maximum amount possible in order to keep you there. Now, the second scenario happens when the product cost goes up, but then you just simply decide to buy less of it. So in 1990, you were able to buy 5 tomatoes for $3, and this is just a hypothetical number. Then in 2000, you get 4 for $3, and then 2010, you buy 3 for $3, and then in 2020, you can only afford 2. This scenario typically happens in jobs where they just simply don't have the luxury of having a job that adjusts for inflation. And these are the typical blue-collar work, factory workers that just simply the skill is kind of like repetitive. Like there's no special skill that is required other than you knowing how to, work out machines and, just do production in a way. It doesn't require a special degree, so to speak. So generally those type of jobs, it's pretty flat. Their pay, it's flat. And if they do adjust for inflation, the adjustment is so minimal that it can hardly adjust for the cost of inflation in life in general. Now there's scenario 3, where the product costs rise, but then you decide to remove other products from your shopping list. So it typically happens in the same scenario where you don't have a job that has the luxury to adjust for inflation. So you continue to, do what you can to keep up with the prices, but then it gets to a point where let's say the tomatoes are getting too expensive, and now you're going to have to choose between paying $5 for 5 tomatoes or $5 for the milk, and then you're going to have to sacrifice either or. So let's say in this scenario, you're like, you know what, I love my tomatoes too much. I don't need to have milk. So I can just simply remove the milk on my shopping list. So then you're starting to sacrifice things that otherwise you would have been able to afford in the past. And then the latest scenario, like I said, there's many of them, but the one that I wanted to touch base on, it's the one that's happening today, right? So the product goes up or the services go up, you have to pay more. And the reason why you can afford to pay more is because you have, government printing, and then they're injecting money into the economy. Back in 2008, it was done with quantitative easing, and then in 2020 with the stimulus check. So it creates inflation because there's more money circulating in the economy, and because you have more money at hand, people want to spend more money. That's just general human psychology. Unless you are very well aware of what's going on, most people tend to just grab the extra money and buy more stuff, or like go out and enjoy leisure. And that's the intent of the injection of the economy. It's just something that's a lot more complex than that. But in general, like if I have to sum it up, that's typically what happens, right? So none of the scenarios are good. And like I said, it doesn't come down to just 4. There's multiple of them, but I'm just using 4 just to give you a general idea. None of them are good because they kill your savings. That's why Robert Kiyosaki always says savers are losers. I like to think that it's not necessarily because he wants to insult you, but it's more like, if you think about it this way, if you're putting your savings in your bank account, whatever, and then eventually you're realizing that, hey, I'm putting my savings into my bank account and I'm thinking that by retirement, I'm going to have $3,000. Let's say you put in $1,000 today, and then by retirement, you're going to get $3,000. And you're thinking, yeah, $3,000 is going to worth a lot more. But you don't know what might happen in the future. And with the cost of inflation, hey, for all I know, just the renting of your primary home, you are going to have to pay $3,000. So now, as a retiree, you're realizing that whatever savings you had from years ago is not enough to, afford retirement. So yeah, thankfully you have that $3,000 to cover the rent of your primary residence, but you still got to eat. So that forces you to have to go out there and keep working. Another issue with inflation is that they don't allow you to improve the quality of your life, right? So one of them is because, yeah, you have to go back and keep working. Another way where you look at this. So that same article, oh, actually, this is a very funny article right here. So there was an article that came out in CNBC not too long ago that talked about the upside to inflation is raising wages. So apparently they thought that it was a good thing that inflation was happening because people were getting paid more, just like you will see here. Oh, now instead of getting $85,000 a year, you're making $100,000. And so everybody around was just simply mocking what they wrote, because really, do you think this is a good thing? House fire, silver lining, lower heating bills and stuff like that. Like, you can't really say that things are getting better just because you're getting paid more, because everything else is getting expensive. Your rent is getting expensive. Your general consumption products are getting expensive. So even if you're making more money, you're forced to spending more money. And then they impact your ability to prepare for a financial emergency. Like, we all know for a fact that people don't have savings for a rainy day. Aside from that, panic purchases occur. So you've all seen everything that's been happening in real estate, how, if you're missing out, FOMO, people are like buying like crazy because there's not enough homes. It's causing shortages, and then it continues to raise prices. And that doesn't only happen in real estate. It also happens in, any business in general. So if you look at this article right here, you'll see that everybody's expecting prices to go up. Bottom line, right? So supermarkets are stockpiling inventory as food costs rise because they anticipate that, hey, if things are going to get more expensive, they need to start buying inventory right now because they want to ensure that they can still be profitable and continue to, afford the cost of running a business, hire their staff and stuff like that. But if they wait until prices go up, then you're going to have to raise prices, and you don't know what that's going to happen to the affordability of, the customers who are actually going into that particular supermarket to do their usual grocery shopping. Now, if you happen to be in this situation, don't worry, you're still in time to change the rules of the game. That's why you're watching this class, right? Now, the whole concept about debt can be beneficial to you if you use real estate, or if you do it through real estate. You can create a scenario that becomes advantageous to you in order to fight inflation thanks to debt, right? In terms of debt, for those who have been tuning in for quite some time, you know that there's a difference between good debt and bad debt. Debt has multiple personalities. It is up to you what kind of role you want to assign to it. So in this scenario, we have a picture of bad debt. And so bad debt is not good, right? Because we want good debt that can pay for stuff on its own, right? So bad debt requires you to work and sacrifice your freedom, your time, everything else, just to be able to afford and pay that debt. So an example of that will be credit cards used on items that don't generate cash flow. Let's say you just spend it out there in a crazy party and you spend $2,000 a night for a bottle of champagne, and then now the next day, you have fun the night before, but now you're like, oh my God, I have to work really hard to pay off that credit card bill. However, if you understand the concept of good debt is anything that you create with debt, but then at the same time, that debt it's paying itself off. And you do that through real estate that generates cash flow. You leverage credit cards at 0%. Then you use, other people's money through the form of a mortgage. You put it all into a house, and then you have your tenant help you pay all that out of. That's OPM. And, you rinse and repeat, and you continue to do that again. So bottom line, that's what my friend was actually referring to. So she meant taking up a bunch of credit card debt, taking that money, investing it elsewhere, whatever assets she had in mind, and then use that to generate income, and then use that money to pay off the debt at an inflationary cost, which translates to cheap money. And so that is the reason why she's not the person teaching this class, because not everybody can teach concepts like that and break it down. So I had to come in and try to figure it out and be able to lay it down in a way that it's simple enough for everyone to grasp the concept around. So now, let's talk about that. And this is one of the things that we actually learned at the conference that we went, the Noble Rice team and I went a couple of weeks ago. And this is I like to say it's a quote from Russell Gray. He mentioned during the class presentations to not be afraid of debt. Instead, just learn to respect them and work with them, because you want to use them to your advantage. So in this case, when I said don't pay for your house and yada yada, I mean, don't use your own cash, don't use your own money to pay for your house. You're going to, get your hands on real estate and then use that to generate cash flow, but you're going to do it through other people's money. You're going to leverage cheap money because the rates are very low right now, and they're going to continue to be low for a long time, even though there has been talks about raising that. I don't anticipate the Fed raising, the rates from where they are to like 10% overnight, right? Like I like to believe that they're going to do that gradually. But yet, this is just my opinion. This is just my thinking. I don't have a crystal ball, so we don't know, right? And through all of this, there's inflation. So you're going to use inflation to your advantage and annihilate debt, just the way my friend was just talking about a couple of years ago. So one thing that is really important for you to keep in mind is that in order for this strategy to work, you really, really, really need to change the way you look at money, okay? It is very important you do that. Money is not wealth. I know there's a lot of confusion around there. People think that the more money you have in your bank account, the more cash you have in your hand, that makes you rich. No, money does not make you rich, okay? Not at all. Money, this is what the real concept of money is. Money is productivity, okay? Money generates output. You use money to hire talent. You use money to create something. Money, it's a way to create time, because when you can delegate, you can afford to hire somebody to be leaders in your business, you are getting time for yourself so you can continue to grow, whether it's educating yourself, investing more time in your family, you name it. But it is a way to creating time. And it is a vehicle that leads to the creation of your wealth, right? That's what money is. Money is a tool. It's not what makes you rich, okay? Remember, when you have money, right? Let's say you start holding all of that cash and you put it in a savings account or under your mattress, whatever you want to call it. Money in itself doesn't really do anything because it doesn't reproduce itself, unless you're the government and you have a printer and you can, just create cash out of the blue. But money in your hands doesn't really do anything, especially during inflation. It is the worst thing that you can do, because whatever amount of money you have today might not be worth the same tomorrow. So if you have $1,000 today and you can, afford for the rent of a 2-bedroom house, tomorrow you don't know that. Tomorrow might be able to just get you a studio apartment. You don't know that. So it is important that you are very well aware of that, and that you can take that money and instead of putting it into a savings account, you practice what the rich do, which is investing that money into something, in this case, an asset that's going to help you generate even more money. And so that same money can just help you cover up that debt. That's in essence what this strategy is about. So back to the topic of inflation. Inflation destroys. There's no two ways about it. But if you educate yourself, you can really use inflation to your advantage, because just the way inflation destroys money and savings, it also destroys debt. I mean, it annihilates it if you know how to use that. Inflation causes things to go up nominally. And by nominal, I mean things that you see on paper, the number, not actually the value of an asset. You just see, on a balance sheet or in your paycheck, a number that goes up nominally. And that allows you to pay debt with cheap money. And in a minute, I'm going to use an actual visual example to help you get a better grasp of it, because even I had a hard time getting around that when I first heard about this whole concept. But most importantly, if you understand the difference between real money and nominal money, then you're ready to fight inflation intelligently with that. The point is for you to be aware that real money is what really allows you to buy more things. But when you have nominal money, it doesn't allow you to buy more things, okay? So here's a visual example. Let's assume you have a house here that was worth $120,000. And that was the pricing back in 2000. And this is based on real data. I actually had to go into Zillow and pull that up. And I'll show you in a little bit how I did it. Let's assume that back then in 2000, you were able to buy a house at $120,000, assuming you put a 20% down for a down payment. Your mortgage wound up being $515, right? So $515 is only principal and interest. And then at the time, you had a monthly income of $3,750. Now, the reason I decided to use monthly income and not monthly salary is because of you. You're here to diversify. You're not here to depend solely on your salary. You want to have a job just because you enjoy it, but then at the same time, you want to have investments so that way you're comfortable financially. So, in terms of monthly income, I'm including both. I'm including income from an actual profession that you may have, and also your investment income. If it's just solely on your investment, congratulations. But if you have both, also great, congratulations. Now, you fast forward 20 years, that same house is going to appreciate, right? So part of that appreciation does contain market appreciation, but it also contains inflation. Remember, inflation is not necessarily a horrible thing if it happens gradually. The average inflation cost, the healthy inflation, will be 2% a year. But it's bad when it happens, it goes up the sky just all of a sudden. And this moment in 2020, that same house that you paid $120,000 for back in 2000, it is now worth $260,000. And if you were to buy a house, that same house in 2020, your mortgage will go up to $878. And of course, your income will also be adjusted for inflation, because aside from your job, you have investment income. So now you have $5,000. If you come and you just take a step back and you look at this picture, if you were to buy a house in 2000, your mortgage is going to be fixed at $515 for the next 30 years. So that means that in 2020, you're having a house that is currently worth $260,000, but you're paying for the price back in 2000. And so when you adjust everything to inflation, we're talking about cheap money here, because if you come to think of this, you are making more money and you're paying less for it, because now in actuality you have your income adjusted for inflation. So an example in real life that I have, it's my first condo that I invested in Alabama back in 2016. So when I bought that condo, I paid $90,500. So that was the purchasing price. Today, that same condo is worth over $145,000. But because I got set on a mortgage at the time in 2016, my monthly payment on that mortgage is only $333. That's all I pay, $333. But today I'm making a lot more money, and the rent on that unit continues to go up. And quote unquote, I'm using cheap money to pay it off because I'm making more nominal numbers because my tenant is paying me more. But the cost of that mortgage, the expense that I have on that mortgage, it's pretty much fixed, right? So now that you understand this, it is time to get into housing debt, right? So that's the whole concept of leveraging debt. You use that to fight for inflation, and then you let OPM to help you take care of that. Let's say some of you might have questions and say, well, I don't understand. You commented in an old video back in the days that it was better for us to wait for houses to drop in price, right? That's the analogy of what this says here. But then if you go back and you watch the video again, you will realize that I also said that it was a good time to buy. It is always a good time to buy as long as the numbers make sense. So once again, the purpose of that video was to educate everybody so that they understand what was going on in the market. Not all homes are good investments, and I didn't want all of you to get engaged on bidding wars just because you wanted to buy a house, just because you wanted to say that, hey, I am an investor. The numbers have to make sense. However, one of the great things about real estate, depending on how you look at it, is that the market constantly evolves. So you have to monitor the market all the time. That's why you always have to do market research, understand what is going on. So now that we are in July 2021 and things are starting to opening up again, people are starting to get back to work, and now we can get a better understanding of how work is affecting migration, right? So for those who were fortunate enough to work from home, some of those families were able to move further out of the metropolitan areas in search for a bigger space. I actually have a couple of friends who decided to do that because when they were working together at their jobs in their one-bedroom apartment, that was leading the marriage towards divorce. And they didn't want to do that. And both careers were important. They didn't want to talk over one another, but professionally speaking, that wasn't good. That your wife will be having a meeting and then your husband will be having another meeting right behind your back, yelling at each other to see who spoke louder. And the clients, they don't like to see that. So that type of family ended up moving out to the suburbs. They bought a nice, 3-bedroom apartment house with 2.5 bath. So that way during working hours, they can lock themselves in their nice bedrooms and not having to deal with one another until, their working hours were over. So now fast forward to July 2021, companies are realizing that, hey, this is great. We tested our system. People can, in fact, work from home and they don't have to come back to the offices anymore. Yeah, we're going to save more money on office costs. But there are some people who maybe they did wind up getting divorced, or maybe they realized that, hey, working from home is not their cup of tea. They miss the office interaction, they miss commuting, and that's great. So those type of people or those type of workers, they need to come back to the metropolitan areas. So the demand for all type of housings, it's already kind of like leveling up again. So what impacted New York a couple of months ago and the rents were going down, that's not going to happen anymore. So the rents are picking back up. The demand for apartments are picking back up in metropolitan areas. And now we can see that the movement, it's somewhat, I don't want to use the word permanent, but I can't think of a better term. So people are pretty much set. Okay, so now you know that whoever moved down to Texas, whoever moved down to Florida, it's going to stay there. And whoever didn't get to move out, most likely they're going to just remain here in the city, right? The houses are not going to go down in price because you already have seen in the videos that supply is very low, demand is high, people want to get their hands on it, and the market is actually backed up. They can't just simply provide housing because the issue has been going on for years. So I actually have an article right here that I wanted to share with you. Here we are, housing shortage tracker, and this is pre-pandemic level. So there was a housing shortage even way before the pandemic. You see? So all this area in red, people needed housing. Look at Florida down here. Look at Miami, red, New York, red, Connecticut, red, like everything. All of these areas in red, Texas red, Alabama red, California red. And so what happened is the pandemic came and all of a sudden it just simply made it worse. So they're already at a shortage. And then now things are slowing down. And in addition to that, there's no lumber because, the whole production system had to get shut down, social distancing. Then you add to that whatever happened in Texas, and Texas got shut down. So it's just a series of effects that what they ended up creating was just, a domino effect that slowed down the housing production process even more than even before pandemic levels. So there's going to be a while before all of that starts picking up. And so what does that mean for you as a real estate investor? It means that some people are not going to be able to get their hands on becoming a homeowner because the entry point, it's really high right now. The families who want to become homeowners might not be able to become homeowners just because of the fact that they cannot afford it. And that forces them to be renters. And so the demand for rent is here. For those who are concerned, because I know that one of the biggest fear that everybody has is, okay, so housing is expensive as a real estate investor. I don't want to buy a house and then not being able to afford that because I might not make enough rent. That's why you run your numbers. You don't go in blindly to just buy a house based on how you see yourself living in it. No, you run the numbers, you make sure that you have cash flow, you make sure that you can cover the operating expenses, the financial expenses, and that's based on that, you make your decision and off you go. And so if you were afraid that, a crash might be coming and that the demand for housing will be gone, just like it happened in 2008, think about it twice because there's evidence here that supports that that's not the case because people cannot afford to buy homes. So they are forced to rent. Single family rental market index, highest of all time, 90.3%. Occupancy index, 80.1%. This is at a national level. I know that some states might differ from one another, but this is an average of the entire country. Leasing activity index, 94.5 on the first quarter of 2021. So these are real numbers right here. Record high single family rental demand in many geographies drove several index components to the all-time highs. National median rent at $1,741, up 6.1% in Q1 2021. So that only translates to there's more demand for housing. housing, and rents are going to continue to go up because there's not enough housing in the market. So the demand is there. Okay, so let's get into housing. That once again, according to the data, the demand for housing will not go down. And this is something that we actually had the pleasure to learn at the conference a couple of weeks ago. We actually had Doug Duncan as a guest speaker that, share his viewpoint on what's happening in the economy. So despite the pessimism and home buying conditions, I mean, nobody likes to overpay for a house, right? We expect demand for housing to persist at an elevated level through the rest of the year because people want to buy, people want to take advantage of the low rates, and everybody wants to become a homeowner. But the reality is different. The fact that you want to become a homeowner doesn't mean you can. So there's more and more short of housing today more than ever with all the migration going on, right? And so the best time to buy is now. The reason why I'm creating this is because I want everybody to stop focusing on the price, because people seem to be waiting for something majorly catastrophic to happen. I want to wait for the forbearance things to end. I want the foreclosure rate to happen right now because I want to buy cheap. So instead of waiting for the economy to crash and go downhill, I mean, at the end of the day, you don't want that as well. Let's try to refocus your attention on, okay, can I still create value here? Okay, the product is expensive. In this case, the product is a house, but can I also add value and generate more money? Can I increase the rent? Because, hey, chances are if the property prices are going up, that means property taxes are going up. And as an investor, the logical thing is to increase the rent because otherwise you're not going to be profitable. So if you're not going to foreclose on the mortgage side, you might end up foreclosing on the property taxes side because you still have to pay Uncle Sam. So taking a step back, if you consider all the scenario and everything that's going on, you will realize that when you go into real estate investing, you are buying the house with other people's money. You're using the bank, you're using a mortgage to buy that property, to invest in that property. So other people's money, the bank's money, the saver's money, and then there's also cheap money because, hey, we're talking about a low rate. And then you're going to pay off the debt using other people's money because you're going to collect that rent and you're going to pay that debt using whatever income you're receiving from your tenant. And based on the example that you saw on the house and the nominal numbers, rent is going to continue to go up, which means it's going to translate to cheap money you're paying back. The mortgage in itself will also lose value over time because of inflation. You have to adjust for the cost of living. So you're getting a cheaper house over time based on its worth. And because of the mortgage loses value, the debt loses its value. And then once again, we're talking about paying it off with cheap money because you're collecting rental income and it's going to have a higher nominal value. And homes are expected to continue to rise in value, which will give you other advantages when it comes to refinancing, doing a HELOC, doing a cash out refi. So you can just simply rinse and repeat and do all of that. And once again, I found another article for those who are afraid of not being able to, meet their financial responsibilities and, being able to walk into a field where houses are really expensive. Always remember, it's all about the value. So the numbers are here. And for those who were talking about New York or talking about California or San Francisco or Boston, highly dense area, pandemic pricing is officially over. Okay, so we need to move on and forget about that. Because if you come in here and you start paying attention to this graph, you're realizing that, yes, okay, so rent did fall sometime last year because a lot of people were living in the big cities. But look at what's happening right now. It is bouncing all the way back up, and it doesn't seem like it's going to come down anytime soon. It's going all the way up. And for those who are, a bit skeptical about what's happening, feel free to scroll all the way down. And so we can look at some of the charts at the local level. So this was at the national level, the national numbers. And now look at Austin, Texas, bouncing back up. Look in San Diego, bouncing all the way back up. San Francisco, California, all the way back up. New York City, all the way back up. So the demand is there. You just have to be able to come in and provide the housing, right? So just to reiterate, do not hoard money because it loses value. Instead, get assets that generate more money for you. Always buy, and I can't emphasize this enough, always buy based on numbers. The numbers always have to make sense. Do not engage in bidding wars just so you can say that, you became a homeowner, or just to say that, hey, I bought my first investment property or whatever. No, you don't want to do that. Let's say for whatever reason, because this is something that's pretty common that I've heard from some people, I can't find a deal with numbers that make sense, right? We have seen cases in where some of our students have, even in spite of this time. Actually, last week we have 2 students who closed on multifamilies. So it is something that can happen. But let's say in the event that you're looking into an area that you really want to invest in, but then you can't find something that will match that investing criteria, then use whatever you have today to create debt. Do it through a HELOC or a cash out refi, so that way you can pull the equity out there and use that money to invest when that right deal comes, right? You want to do that now because, hey, housing prices are at an all-time high, so you want to max out on that HELOC, you want to max out on that cash out refi, and that debt, it's created with nominal numbers again because of all the high cost of the housing, but then due to inflation, eventually you're going to repay that with cheap money, and it's also OPM. The mortgage will lose value over time. So same thing, right? Mortgages lose the value, then you're going to pay it off faster. And then the rent, it's OPM. It's the same analogy, but this time you're creating that using a similar but different strategy. And the best part of this is that you don't even have to deal with a bidding war because you already have the asset in your house. You already have it in your hand. All you got to do is just to pull the equity out before the housing prices do fall in the event that, if it does happen. So let's say, come back to this, remember this analogy. We saw this nice graph. You're paying in 2020 for a house that, it's worth $120,000. And so if you were to flip the scenario with this, what we're having now is that you don't have to think about the mortgage, but you have the equity in here. So now the house over the span of 20 years has appreciated $140,000. You take 260 minus 120, that'll give you an equity of $140,000. You do a HELOC and a cash out refi, and that means you will have $140,000 ready for you to expand or to build your portfolio or to, do whatever investment that you want to do that you find feasible doing with that additional cash. The key is to not hoard the cash, but invest that cash in something that can generate cash flow. And because this is a real estate channel, we're talking about real estate. And that's the best way to go because not only generate cash flow, it also generates, expenses for you, depreciation, which you want that to reduce your taxable income. Right? So in the event that you're still doubtful, because I understand that the media is creating a lot of noise that is very scary out there. And when you look at some of the numbers, it might seem that we are walking into another 2008 bubble. Maybe yes, maybe not. We don't know that. There's no crystal ball. But what we need to do here is just to simply reduce the noise and start looking at the facts. Okay? Remember, real estate is very versatile. They can talk about all the national numbers and because they have to take an average overall. This is a big country. But if you specialize in a localized area, then you're going to realize, then you're going to see that not every single real estate market is the same. So here you have a chart, and this chart, believe it or not, I'm going to share multiple charts with you. This wasn't easy to pull up, and it was very eye-opening. So the way these charts were created, I actually went online to try to see if I can find some data, and nothing met my criteria. Like the data was useless. So what I had to do, I had to invest 10 hours of my time, and I went to Zillow Research right here. And the reason why I'm showing you this is because I want to prove you that these are not bogus numbers. Like these are real statistical numbers, like real facts that I ended up pulling from Zillow just so I could create this number. So the way I did it is that, I did a selection. I pull the data from single families and condos. I use the historical home values and I also use the historical rental values. I downloaded that and this is what it created, right? So here's all the raw data just to prove you that this was real stuff. And in fact, there was so much data out there that was raw, unclaimed, that it crashed my computer a couple of times. But, slowly but surely, 10 hours later, I was managed to clean it all up in a way that it would look nicely appealing to you, just the way you're about to see right here. Okay, so now that we know this, let's just take a look at the housing prices fluctuation in Florida. And this is based on historical prices from 1996 all the way to May 2021. We don't have the full year because we're in July, and remember, data is not always 100% up to date because you got to give time to the researchers to go out there and collect the data. So all we have is May 2021. And so if you start paying attention, yes, markets are cyclical. What goes up must come down. There's always going to be a reset in the market. And you shouldn't be afraid of that. You should educate yourself to understand, okay, so how do those ups and downs happen, and what's the worst case scenario? So what I decided to do, I decided to take two marks here and historical charts, just so you can get a sense of how things look in here. So Florida, if you look at 1996, you will see that the lowest housing price, and this is an average across all the state of Florida. Remember, even each county is different, but if we were to look into each county, we were going to be here for weeks. So what I decided to do was to take an average, all the prices from 1996 all the way to 2021. And you will notice that, yes, even though there is a reset in the market, there's always a new low. So the first low at the time in 1996 for a house in Florida was $102,398. And then, craziness happened. We got into a bubble, yada, yada, 2008-7. And then the market started resetting. And then the lowest low, or the newest low, came in at $141,940. So the reason why I'm showing you these numbers is because I want you to understand that inflation does play a role, although not necessarily bad all the time. It does adjust pricing. So when the market resets, generally speaking, is not going to fall further down than the oldest low. It will have a new low. And this chunk right here, it's what's going to make, hey, this is the gain, or this is the cushioning that you have. I mean, whatever way you look at it, the point that I'm trying to make here is that it cannot get any worse. And as long as you understand that, you have to plan according to, hey, what's the lowest possible scenario? So now that we are here, you might want to consider, hey, based on the research, based on the statistical numbers, are we going to continue to go further up all the way here? We don't know that. But based on the projections, it seems to be a possibility because of the shortage of homes, right? And if it does, when it's going to be the newest low? Is it going to be this one? I doubt it. It's going to reset. But eventually, hey, it's going to reset at a less lower number. But that's not what I want you to focus on. I just wanted to sort of like show you a depiction of what could happen across markets. If we were to pay attention to California, California has, a similar pattern than in Florida. It's a little bit less volatile than Florida. We got the lowest low at 160, but then we have the new low at 311,277. But then if we come to New York, look at what's happening in New York. It's like almost minimal because, yes, we have our lowest low in 1996 at 137,000, and then in 2012 it reset at 251,670. But most people seem to be focused on here in 2008 and 7. And if you were to pay attention to this, wow, that reset was so minimal compared to, this, like, oh my God, look at this big jump all the way down here. And then look at Florida, like this was bad. So the markets, depending on the state, depending on the area that you are, they don't necessarily will act the same. And look at Texas. With Texas, it's even less noticeable. Look at this, 2008, and then look at it 2012. So my point here is you have to be able to understand the numbers. You have to be able to understand what happens in the market. And that's why I keep reemphasizing that real estate is very versatile. So therefore, you have to do your research at the local level. And so here, there is another link that I provided to you. Actually, took me quite some time to find this, but this will save you a lot of time because depending on the area that you want to do research, you can just simply click on the map and it will take you to all the local data that you need to know. Relocation report, quarterly housing report, home buyers and sellers reports, land sales report. Let's say you want to look at the relocation report. You download the copy of the report, you open it up and look at all those numbers, all make and laid out nicely for you. Where are people coming from and moving into Texas? We got California, Florida, Louisiana, Illinois, whatever. Statewide relocation, average prices, where are they going? So you have to do the research and understand what's going on in the market, right? The market will always need corrections, as you saw, but don't focus too much on the correction. Just focus on, okay, how do you adjust to the inflationary value? How do you adjust to those corrections? The newest low will typically have a higher nominal value than the previous low. And the correction doesn't really matter as long as you manage to make a profit out of it. And that profit, and by profit I'm talking about cash flow, it doesn't matter if the market corrects itself as long as you generate enough cash flow to cover your operating expenses, your mortgage responsibilities, and most importantly, make a profit. And all of this will be possible through rental income. Again, don't get too hung up on, oh my God, the houses are expensive. Get focused on, can you make a profit? Can you get something good out of this? And here I actually compile even more data, and that's a part of like 10 hours plus of analysis. This is what you get. So if we were to compare, this is the same graph that you saw a couple of minutes ago. If we were to compare housing prices to rental trends, look at what's happening to the rental trend. Yes, so the housing prices are more volatile, yada, yada. It's going to correct themselves. But look at the rental values. The rental values are going upwards. And this is all possible because of the demand. And it's going to continue to go up because people cannot afford to buy houses. Houses are more expensive. So you have to be able to provide rentals. People need homes at the end of the day. People don't have to be homeowners. It will be nice if they can become homeowners, but they need a house. People and family need a roof over their heads. And then if you move towards California, same thing. I know there was a lot of noise about California going downhill. Look at this data. And this is coming from Zillow, okay? I didn't make this stuff up. I don't know what the heck people are talking about in the news about California, going downhill. It doesn't seem like it's going downhill to me in here. And it certainly doesn't seem like it's going downhill with the rents either. And then if you look at New York, it's going uphill. It was the impact of the 2008 crisis was like almost minimal to what happened. And then look at the rent. In general, you do have an upward trend. I know that in 2020 and in 2021, it sort of like went down because of what happened with the pandemic. If you put all the information together and you look at the historical data, you will be well aware that, New York was the epicenter of COVID. So a lot of people were moving out in fear of what was happening to COVID. People didn't want to be crammed down with one another. So they moved out, but based on the rent, on the graph on this article right here, you can see that, hey, it is bouncing back up. So you will sooner rather than later see this reflected on this chart. It's just that Zillow hasn't caught up to it just yet, right? Now, coming back to this, and we want to talk about Texas as well. So the impact of the 2008 crisis was somewhat minimal compared to California and Florida. It is trending upwards, and so is the rent. Okay. Now, still doubtful. Properties are so expensive right now because that seems to be the theme that I keep getting over and over again. And I think more or less the students are getting sort of like fixated on the wrong thing, right? So always remember how I talk about in the class, in the course, in the program, doing investing is business. And business is all about creating a win-win situation. It's all about providing value. So you have to look for ways to add value. Based on the data, based on the research that I performed and shared with you today, you're realizing that, hey, the trend is obvious. There is a housing shortage, right? So our jobs as real estate investors is to solve that problem and add value to the community. Remember, always create a win-win situation. If the house is so expensive, look for a house that needs you to add value to it, and then you make a profit out of it. So a simple example will be, let's say you find a house in a market that it's currently for sale at $120,000, and it's at $120,000 because it needs some cosmetic fixes. So the current rent in the market is set at $1,000 because the current owner doesn't want to add value. Maybe they're about to retire, they don't care, they don't have the budget, whatever. But based on your research and based on your conversation with your power team, that the market rent in that area could be $2,500. You already proven that. You already pulled comparables. You already done your reports, done your numbers, and you know that there's a possibility that you can add value and bring it up to the standard that you want. So you buy it, you do the fixes, the cosmetic fixes that are needed, you bring it up to $250, and now you get a new market rent at $2,500. So now you created a win-win situation for the tenant that's looking for a home. You created a win-win situation for yourself because you added value, and voila, now you took care of like the whole expensive issue. As long as you can generate or create value onto something, you are good to go. Profit just happens to be a side effect of it, right? It's another thing that we learned during that conference is to shift our attention into how we can create value. And then once you focus on creating value, the money will come to you. Okay. Now, Again, for those who are still doubtful, I don't know, I'm scared, this reminds me of the 2008 bubble. Well, consider the following, right? Back in 2008, there was a lot of predatory lending. People were uneducated, people were unaware of what was going on, and people can just simply walk in with zero down payment, zero credit, no doc loans, and whatever. That's not the case nowadays. I mean, the product is still available. You could go out there, but one of the things that's happening is that now the lenders are asking you for proof. So you need to prove that you have been in business for quite some time, that you know how to manage that money, that you do have a portfolio of rentals, because it's something that they require of me. And I have to provide that. So like the scenarios just change a little. If you have zero experience and you just an investor wannabe and you just walk in and, hey, I have no experience, but I need you to loan me $500,000. It's not going to happen. You have to prove yourself to them. The 2008 bubble crisis happened also as well because of the adjustable rate mortgages. ARMs are not necessarily bad. You just need to learn how to use it, right? Like I said, the product in itself, they were created to provide a solution. But it is up to the customer to educate themselves and learn how to use it. So what happened back in 2008 was that a lot of people decided to get into real estate investing. They bought a bunch of houses, but they didn't really understand that what they were signing up for was an adjustable rate mortgage. So they had the rates fixed for 5 years? And then after that, the rates just started going up because that's what the market was dictating. The rates in general were going up. So once the mortgage started resetting, they had to pay higher monthly payments and the rent stayed fixed. So they couldn't really figure out a way. They have to start paying out of their pockets in order to keep up with, the adjustments on that mortgage. And then eventually they lost their job, and that's how they wind up losing their houses. In this case, in this scenario, we're talking about a fixed mortgage for the next 30 years with a very low rate. And if you can guarantee that low fixed rate, you're pretty much set all the way until the end of the mortgage. It also happened, the 2008 crisis also happened because people were investing in mortgages with collateral that weren't worth what was worth on paper, and that's what they call the secondary mortgage. That has to do with companies or like people in general investing in mortgages. So that's a topic for another video. It's quite lengthy to cover that here, but things are a little bit different now with the collateral that's backing that mortgage because of the shortage of the houses. And the expectation is, based on the data, houses are going to continue to go up. Mortgage forbearances, because a lot of people keep talking about, oh, it's going to come to an end, it's going to come to an end. Well, think about it twice, because mortgage forbearances are being renegotiated. So if you were waiting for the next wave of foreclosure to happen and for the world to end and all of that stuff, well, let me break it down to you. 77% of homeowners in forbearance, now they have a repayment plan in place. Everybody's renegotiating because people learned the lesson. The banks learned their lesson, you will hope, that, hey, we cannot afford for another 2008 happen. So how can we work with the investor or with the homeowner so that way we can break down the payments in a way that is beneficial, and we created a win-win situation for the homeowner so they can keep their homes, and a win-win situation for us as the bank because we want to continue to collect on that mortgage, of course. More on the forbearance side, the number of mortgages and delinquent status also fell down to 50% in comparison to 2008. So that's somewhere down here that I saw that. I'm not sure where, but it is somewhere in this article that I saw it, and that's why it's here. So the link will be available for those who actually want to go into that and want to learn a little bit more about that. And as you saw earlier, the article, inflation is quote unquote helping raise wages, which allows you to cover the mortgage expenses, whether you're a homeowner or a tenant, thanks to its nominal value. The supplies of houses have been behind since 2019, just like I shared with you on that map with the housing shortages. The pandemic just simply made it worse, and the cost of houses are going to continue to rise, making it difficult for families that don't have access to capital. So therefore, demand for rent will continue to rise. The rents are relatively more stable based on the graphs that you saw compared to housing prices, and the vacancies rates are at the all-time lows based on the data that I just shared with you. And we also have historical low rates. So for those who were kind of concerned about, rates rising, because that's another issue. People are like, oh, let me just rush to the bank before, the Fed raises the rates and all that stuff. Let me pull you all the way back to the 80s and the 90s, just so you can get a good benchmark of what the rates were back in the day. So here it is. We have 1978, 1992. Look at what the rates were. We have 9%, 10%, 12, 14, 17. And then if you go up 13, 10, these were really, really high rates compared to today, 2021. Look at this. I don't know what people are complaining about. And even if you were to raise that a little bit to like, I don't know, three something is still better than 13% or 17%. So once again, focus again on the value that you can add. Focus on, can I make a profit out of this, rather than, oh, the house is expensive. We're talking about cheap money here. Historically, we're talking about really, really low rates. And because of inflation, you're going to be able to collect, quote unquote, more rent in order to, pay back the mortgage with cheap money. If you're still fearful, I kind of like anticipated this. So I went in and I dove in a little bit deeper and I pulled data from the Census Bureau, right? And this is just very, very recent. This is the latest survey report that they have. Rental vacancy rate, 6.8. If you look at the vacancy rate at 6.8, this is low compared to everything we've been getting all the way back to 1998. Homeowner vacancy rate, 0.9, like almost like negligent, because, hey, people need homes to live in, right? They need a roof over their shoulder or over their heads. The median asking rent continues to go up. Based on what you see here, it doesn't seem like it's going to come down anytime soon. The median asking sale prices for vacant sales unit, it does seem that it's going to start resetting. But hey, again, let's just focus more on, hey, what can I get for rent, rather than focusing on, hey, I want to wait until houses fall. And even if there is an adjustment on the housing prices, we don't know what's going to happen. What's important is you're locking yourself on the good rate. You are getting that demand fulfilled by providing housing to people, and just continue to protect your assets. Now, you might be wondering, why are you sharing this with me, right? Why am I doing this? Well, like I said, I went to a conference a couple of weeks ago, and I went there looking for answers because I made a series of decisions that felt right at the time, but my gut feeling was telling me that I wasn't doing the right thing. So earlier this year, I made the mistake of paying off some of my mortgages. I had some additional liquidity set on the side, and there was a lot of noise in the media, and I decided to give in to fear. This is why, it can happen to the best of us. This is why I always continue to emphasize that you always have to make your decisions based on numbers. This time around, earlier this year, I made my decisions based on fear because I was afraid of all the noise that was happening with the forbearances and whether my tenant was going to lose their job and yada, yada. And so I said, I don't want to deal with that. I don't want to be one of those who become part of the 2008 statistics and be one of those investors, quote unquote, who didn't know what they were doing and losing their home. So I paid it off. And then I realized that mortgages are not worth paying off due to everything that's happening with the inflation. And I was like, oh my God, like now I'm rushing and I'm working with a bunch of mortgage brokers just so I can pull all that equity back out again. Because I realized that inflation destroys debt and the debts are being paid with OPM. So whatever mortgage I had at the time, and now with the new cash out refi that I'm going to have, it's going to be paid by the tenant. And so it's not like I'm just pulling money out of my pocket, but I did pay off that mortgage earlier this year with money out of my pocket. Like that was money that was supposed to be used to reinvest in another company that I had. But instead I decided to move money around just so I could just pay off that mortgage. And it wasn't a smart move. Again, we don't have a crystal ball. Everything is based on a projection. I cannot make predictions because we don't know what might happen tomorrow. But based on the data shows that houses are projected to increase in value. But assuming the worst case scenario, let's say there is a market correction, if housing values were to fall, I don't want to have all my equity parked on the property because it will disappear. So let's say my house is worth $500,000 today. I decided to pay it off. And then 3 years later, an emergency comes in and I don't have any savings, and I figure, okay, let me just do a cash out on the property that I have because I need that money. But then by then, 3 years from now, the house is only worth $300,000. So I lost $200,000 in equity just because I decided to park all that equity in there. And I'm not going to wait for that to happen. That's why I'm pulling out the equity today while the prices are at an all-time high, because I want to be able to have that liquidity with me and have that money ready for other investments, for an emergency, whatever you want to call it. And the beauty of that is that because you have access to that liquid money, you can put that towards another investment that's going to generate cash flow and help you pay off that debt while that debt is already being paid off by, OPM from your tenant. And so again, what matters to me, and this is just my case, I can't force anybody to, follow what I said. This is not a prescription for you to resolve your investment issues or your investment questions or doubts. I'm just sharing this information because that makes sense for me and that's what I'm implementing. And if you're out there watching or listening and this does make sense for you, then feel free to implement some of this. The purpose of this video is once again to educate yourself, to help you have critical thinking, to not be one of those people who say, oh, but this person told me to do this and I just did it. No, you always have to trust but verify. That's why you're watching this video, so you can educate yourself. What matters to me is that my rental portfolio, in this case, continues to generate cash flow based on the information that I just share about the rental income going, up and all of that stuff. Because what I care about is to make a profit so I can meet my financial obligations. And then once again, always create value, right? It is obvious that there's a problem out there. And the problem is that we're not generating enough housing. There's not enough housing for everybody. There's a high demand and little supply. And this problem seems to, continue. And it's going to add on to the affordability issues, because the least amount of houses there is in the market, the more expensive they're going to become, because people are going to want to buy. And so that it's going to exclude those at the lower entry points who cannot afford that. So they're going to need to rent a house. And this is when you as a real estate investor come in, because you want to be able to provide a roof over their heads. So stop focusing on the price of the property, focus on the profit, and focus on you can help and add value to the community. Now, remember, don't be afraid. I know this is a lot of information. I was afraid when I first found out. Just remember that you're now smarter than the person you were about an hour ago. So use this information to your advantage. I know it is a lot to process. And if it is, just simply take a break and then watch this video again later. And watch this video as many times as necessary, because you will need it. And you will need it to get comfortable with the information so that you can eventually take action once you're ready. In my case, it took me 3 weeks to finally get ready and do some of this stuff. It could take you 3 weeks. It can take you a week. Maybe you're already doing it. And if you are, congratulations. But this is in essence what I wanted to do today with this video, to educate you, to help you, have a different viewpoint as to what's going on in the market. And that's pretty much all I have for you today. I hope you found the content very valuable. And if you did and you haven't done it so, don't forget to share this content with someone who you know is going to benefit from that type of information. Friendly reminder for you to get the like down here, and also to check this episode right here that's going to complement everything you just learned today. And until then, I'll see you guys soon. Take care. Bye-bye.